Hey there, we're just getting started. Hello there. Nice to see ya. I'm Mitch Goldberg, your host. You're watching my live stream. Be the boss of your money. When I say be the boss of your money, it's partly because I couldn't name the show Money Boss because that was already taken. And I thought it sounded more clever than, control of your money or something, which could have been a better title, but maybe we should have called this. maybe we should have called this Money Control. That would have been a cool name. This is Money Control. Come in, please. Or Money Patrol. Anyway, it's called Be the Boss of Your Money. It's about taking control of your money because it's very easy to lose control of your money. It's very easy for your money to take control of you, or I should say, lack of money. Yeah, well, actually, sometimes people just are flush with cash at a given moment, and they run amok. They don't know what to do, and they don't have a plan for it. I'm a very big believer in making a plan, even for little short term things. It's like if I pack a suitcase, I kind of make a plan. If I go on a trip, I make a plan. It's hard to make a plan because it slows me down. But I know myself, and that's the hardest thing about being an investor. The hardest thing is to know yourself. So I know that I need to slow myself down. It's part of my growth process, part of my maturity. Just as time has gone on, I've learned that about myself. Have you learned anything about yourself? I wish I'd learned this about myself many, many years ago. Anyway, while you're watching, I know I'm watching, but are you watching? Yes, you are. So hit me up with questions in the comments. I love hearing from you. It's the best part about doing this. If you have any questions about the topics you're talking about or a money question in general, just hit me up in the comments. I'd love to see it there. Or just say hi or where you're watching from. If you don't mind, give us a like, a heart, a wow, or an applause, whatever reaction is available to you, depending on which social media platform that you're watching from. And I'll just put up some of the social media platforms that you could find me on. Okay. I'm on Instagram at InstaMitchG. I'm on YouTube, Client First Strategy. You know who I am on LinkedIn, Mitchell Goldberg. I'm Client First Strategy on Facebook and at Mitch_Goldberg on Twitter. Although Twitter, I used to be very big into Twitter, but I don't really go on Twitter much. So if you send me a message or a note or something, a DM on Twitter, and I don't get back to you, please don't be offended. You might be better off hitting me up on Facebook or especially LinkedIn. LinkedIn is like my number one platform. Anyway, what's going on today? Okay, first of all, I think we'll have to just stand up or sit up straight and acknowledge what nobody wants to admit, that the golden era of social media is over. That golden era of like 2000, let's say 2009, 2010 to like 2020, that was the golden era. And at the end of it, like 2020, especially with the pandemic, that was like the peak of the internet. That was the peak of online. That was the peak of people spending time online. It was also the peak of, how great social media could be. And it was also the peak of, viewer time. The world opened up again and we are back to doing other things. We still might be using social media more than, let's say, 2019. But we want growth, not back to where we were. And unfortunately, that's back to where we were is what you have. And I think the witness for that is, by the way, Brett is out there. Thank you for the thumbs up, Brett. I really appreciate it very, very, very much. But let's take a look at proof positive. Let's take a look at Snap, okay? Snap, okay, is down 25% in aftermarket trading. Can you imagine you make an investment, you look at it, you review it, you wonder, what's your time frame, what's, how long you're going to hold on to it for, and it drops 25%. I know you're looking at this on the screen. Oh, well, a $10 stock going to 8, it happens. No. If you put, $100,000 in the stock market and then half hour later, aftermarket trading, it's down 25%. That would suck. Okay. That would really be a painful move, just to put it in perspective. Now, generally speaking, the stock market doesn't drop 25% in a day. Individual stocks certainly can, and individual stocks can go up by that much. That's why the averages, the main indexes, are a lot more stable than an individual stock. It's one reason why, as pros say, that most investors are probably not suited for individual stock investing. By the way, you can't invest directly into an index, but you could invest in a security that tracks or mimics an index. In any event, we've got a couple of things to talk about besides negative stuff like the end of the golden era of investing in social media companies. Let's roll the quick intro, and we're going to have a nice quick show. We've got places to be, folks. I'm wearing a nice white dress shirt. I'm going to be putting on a tie, and I'm going to be heading over to Ohika Castle in about an hour and 15 minutes, and it's going to be great. We're having a major blowout party for my networking group. We're raising money and awareness for United Central Palsy of Long Island, and it's going to be just an absolute blast of a night. Here goes the intro. All right. Sometimes the intro gets stuck in my end, not on your end. So hopefully that whole thing played through. And hopefully I was just staring at a blank screen like this for more than like a couple of seconds. So let's talk real quick. The big question that people are asking is, should I get out of the market? Should I sell everything? And people have been thinking about that for a couple of months and some for longer. But people have been thinking about, let's say for a while, people have been thinking, should I get out of the market? Should I sell a lot? Should I sell half? Should I sell 25%? Just get me into cash, get me out of the stock market. I'll get back in later when it's lower. And there are an awful lot of you who are kicking yourselves saying, if I had just gotten out, I could have been getting back in now. Okay, there's a few things wrong with that. Yes, if you got out, a year ago and you got back in today, you would have saved yourself some heartache and you would have bought back everything at lower prices. That is not a workable strategy. And that's why people like me say that's not a strategy. Once in a while, excuse me, got an itch in my eye. I have to start that sentence again so Natalie could catch that good clip. Once in a while, your hasty decision to sell everything or to sell half of everything or a major chunk of everything you have that's invested in the stock market, be it in your 401k plan or an IRA or your taxable account. Once in a rare blue moon, you do it. It feels good to get it over with and you feel better. You breathe a sigh of relief. Once in a blue moon, the market will go down after you do that. Well, the chances on any given day that the market will go down, by the way, is almost 50%. Almost 50% of all trading days, the market is down. This is why we say if you just miss the top 10 biggest up days in a year, you've missed almost all of the upside, or at the very least, you've captured a lot more downside in a down year, like the one we're having now. So why would I say don't sell everything, don't sell half? Okay, there's a couple of reasons why. And some of you could say, I sold half. I'm glad I did. Screw you. You're an idiot, Mitch. And I'm just so happy I did what I did. And thank goodness I didn't listen to a schmuck like you. I mean, do you really feel that way? I mean, no, maybe it's in my head, okay? Let me tell you why I don't think it's a workable strategy. Because down markets are not separate from up markets. Down markets are part of up markets because the markets recover. Just like we don't know when they finish bottoming, we don't know when we go into a bear market in advance. We don't know when markets are at the bottom and recover. At some point, a bottom becomes the bottom and a new bull market starts and takes us higher again. And at that point, if you're sitting in cash, you're not getting back in. Because just like every 1 or 2% decline in the stock market, I've been saying this for years, it looks like the beginning of a major market meltdown. but most of the time it's just a down day. Second, I don't know, for second, third, we don't get back in because we procrastinate. Well, if the market goes up, you'll say, well, I could have bought when the market was lower. So I'll wait till it goes back down again. And then the market goes back down again, maybe even a little bit lower, maybe a lot lower. And you say to yourself, yeah, you know what? I'm going to wait. I'm going to wait till it stops going down. And then it goes up and you say, I could have bought lower. And you wait for the market to go lower. And it becomes an endless procrastination. We know the way to make money in the market is to be in it long term, not to time it, but time in the market. So you might ask, what's wrong with getting out and getting back in when it's lower? Because it sounds so darn easy to do, but it's not. And almost no one does it successfully. That's what's wrong with it. And the successful thing to do, and I've been doing this for over 30 years. I have clients who started investing long before I came around and they were already successful. They just bought, they held, they stayed diversified, they waited, they went on with their life. The stock market didn't have one bit of interference in how they lived their life. They controlled what they could control. They gave up the rest, trusted the process of investing long term, dollar cost averaging, reinvesting dividends and interest, and they just waited. Okay. By the way, diversification, it's a strategy that doesn't necessarily protect your portfolio from going down. We use it to control risk. But it doesn't mean your portfolio can't go down overall just because you're diversified. People are like, oh, I diversified, I should be up or I shouldn't be down. That's not what diversification does, okay? Diversification is a strategy that we use to mitigate risk. It doesn't necessarily protect your portfolio from going down in a generally down market. It could help your portfolio go down less than the overall market, and it could help your portfolio recover faster than the overall market for the next bull market. All right, that's really what it's about. It helps eliminate single stock and single sector risk. So if you invest in 10 stocks and 3 or 4 of those stocks go to zero or go down and don't come back, you've got a big hole in your portfolio. You see, individual stocks don't always come back, but the major averages, they've always come back. And I'm confident that'll continue. Got one quick comment out there. We have Robbie out there, Robbie Griner. Timing the market beats timing the market. Exactly. Exactly. Thank you very much. I should get a t-shirt that just says that. I should get a t-shirt that says that. I should get a freaking t-shirt that says that. And then when people ask me a question in the comments, I mail them a t-shirt with my logo on it also. Robbie, you are a freaking genius. Thank you so much. I am. I love when I come up with I love it when my viewers give me such great ideas. The t-shirt giveaways. That's good. Look, I'm gonna have this persistent cough for like another month probably. I might even have to go on a steroid to get rid of this cough. I get this like every year. It sucks. Anyway, yeah. So that's why you don't sell half your account or a big chunk of your account or your whole account, your portfolio. You don't liquidate because you don't get back in. The idea is to be in a diversified portfolio that is built around your risk tolerance, your investment objectives, your personal finance. Okay, that is the idea. It's a good idea because it works. This way, when we have a down market, you won't be questioning, why the hell am I in the market so much? You won't be saying, I'm in my mid 50s. I've worked my entire life for what I have, and I'm giving it all away in the stock market, watching it disintegrate. I can't take this risk. Well, if you invest properly in the first place, you won't be wrestling with that question. Now, I know it's too late. Like, oh, now you tell me, Mitch. I know a lot of you think it's too late because some people got caught up in stocks. Some people bought this, they bought that. They didn't take profits. They didn't rebalance. Rebalancing means if you have a certain amount of money in stocks, a certain amount of money in bonds, for example, if stocks go up, you sell a little bit and put some of that money back into bonds to make your asset allocation back to where you had originally set it for based on your risk tolerance. If you let stocks go up too much, they become too big a part of your portfolio, which means you're taking on more risk than maybe you are willing to accept. Anyway, lots of things to do to mitigate risk. One of those things is also tax loss selling. I'm not a tax advisor. You should speak with your tax advisor for tax advice. I don't give tax advice, I have to say, but I know about tax loss selling and I know how to harvest tax losses. And in a market like this, you can harvest tax losses and use them because you are going to have another bull market one of these days. You're going to sell something for a gain and say, I owe taxes on it. And then you're going to pay and then you're going to say, I owe taxes on it. And then next year comes around and the market, the following year comes around and the market goes down. And then you say, I made money, I paid taxes on it, and the market's down anyway. So why did I even bother? Have some tax losses. Like if you have a particular bond fund, let's say an intermediate term bond fund that's down, you could sell that one and buy a different one. Or you could go into T-bills, short-term T-bills. Short-term T-bills are paying 4% now. Not a bad place. I'm not saying take your stock money and put it into T-bills and get out of the stock market because you're giving up your upside. I'm saying your bond money could be moved, some of it into T-bills for 31 days or 90 days, however long you go out with bonds, and then back into whatever you wanted. Or just hold on to T-bills. There's so many ways to create a portfolio. The nice thing about T-bills for me also, for my clients, is they're giving us a sense of control. We know we put into them. We know exactly what we're getting out of them at maturity. We like to know that. We want the certainty of knowing what we're going to get when the bond matures. And we could time it. So if we need money in 6 months or 3 months, or we just want to sit at the market for 90 days and sit at the market for 6 months with some of our money, we could buy T-bills to express that time frame for us. And then when the bonds mature, we could decide what to do, either buy more T-bills, reinvest it, or put it into the market, or whatever you want to do. So you get an element of timing and control when you're buying individual bonds, especially T-bills. You don't have to wait a long time to see for them to mature. And they're paying good yields. You're getting 4% plus now. Okay. So we looked at Snap. Let's take a look at how the major averages did, and then I'm going to let you go. Okay. Let me make this bigger. Dow down 90. It was down 99.99 yesterday. No big deal. That's a fraction. That's like nothing. 90, 100 points. Down 90. NASDAQ down 65 and the S&P down 29. Tesla took a hit today, so that didn't help. Gold continues to stay in the low 1600s. Oil was up a drop, up 16 cents a barrel. Oil was actually up a lot at one point. It was up like $3 a barrel. The fact that it gave it up, that's funky markets when you have like a big rally in something and then it gives it right back up at the end of the day. This is the international sign language for a big rally in the beginning and then it gives it back at the end of the day. There we go. Oh, 10-year, 4.23%. So we're looking just about a 4.25% on the 10-year. Like I said yesterday, that's a reasonable alternative to stocks. I still think 4.25% is too low for me to lock up money for 10 years. I think there's things I could do besides that to get better than 4%. All right. And the VIX is under 30, which on a down day, you would expect the VIX to go up. It just goes to show it was actually a pretty tame, quiet day. Let's look at the bonds. Let's look at the whole yield curve. All right, so 3-month T-bill is at 4%. You see that? 3-month T-bill at 4%. I mean, if you want to hide for 90 days and just keep your cash that's making nothing in the bank, or you want to sell something and hide it, just park it somewhere. 4% for 90 days is on an annualized basis. That is, it's not a bad return. Like I said, if you sell some of your bond ETFs or mutual funds and take the loss, you could go into 3-month, 6-month, 1 year, year and a half, and 2-year treasuries and lock in the 4% range the whole time. And that's probably a better yield than what you're getting from your bond fund anyway. You could always go back into the bond fund at a later time, but at least you took the tax loss and you're still earning a decent yield and you picked up some safety, because what's safer than short-term T-bills? Nothing. Okay. And they pay good yields for that. I mean, they call the 90-day T-bill, the 3-month one right here. You see that? They call this the risk-free rate. There's a reason why they use the term risk-free rate. Okay, just so you know, I just also want to educate my compliance people who are going to be looking at this stuff and wondering, is Mitch allowed to say these are safe? We could say stable, but now we're saying safe. Yes, I can say T-bills are safe. And let's take a look. Oh yeah, so the whole yield curve for a while has been over 4%. It's still an inverted yield curve, and I'll show what I mean. The it's inverted yield curve, so the spread between the 10-year and the 2-year is negative 0.39. It increased a little bit today, but it's been about negative 0.4 for a long time. 30-year mortgage 7.37%. Yeah, it's been a tough market. Did you see that yesterday? Mortgage demand lowest in 25 years. Today, it was new home sales lowest in 10 years. The housing market is just absolutely getting. It's not that the price of houses is going down because inventory is still low. And if you recall, we spoke about this, that everybody out there with like a 2 or 3% mortgage, those houses are locked up as far as we're concerned forever for 30 years. You know, nobody's moving out of those houses to move into a nicer, bigger house at this point, because in the bigger houses, more money, more real estate taxes, and now you've got a 7% mortgage instead of a 3% mortgage. It's just no one's moving. So there's just not enough inventory. So that's holding up the housing market. Some parts of the country house prices are dropping, Texas, Florida, but I don't see it. It's not everywhere. And like we always say, real estate is local. I think that's about it. That's the show. All right, I gotta go. I'm gonna put on my jacket. I'm gonna be wearing a very fancy pocket square. Want to see my pocket squares over there? But I'm gonna get going. I'll speak to you guys soon. All right. Thanks for watching. Be back Monday. Bye.